He will be presenting the project with all together today. And at the end of the presentation, again, we'll have time for the Q&A part. So please feel free to, raise your questions after the end of the presentation. Thank you, Japhet, and welcome.
Thank you, Zainab. Thank you for the warm introduction. Hello, everybody. I'm very happy to be right here. 2 seconds while I get ready here. So pretty much just as Zainab indicated, I'm a resident, an AI resident at Apsiva, and I have already completed five projects, and I'm currently on the job search. So what I can tell you is that um, this is a life-changing experience. To be honest, I have raised my professional standards since I have worked on the projects that I have here. So very sorry, it's like I spoiled it here. Okay, let's see. Somehow, okay, here it is. There you go. So hopefully you are watching my cover page here. I decided to title this course "Leveraging Machine Learning for Smart Stock Price Decisions." And just as some books, they have an alternative title. So I can also call it "From ATMs to GLP-1s" or my painfully funny leap into stock forecasting. So, ladies and gentlemen, let me tell you about my glorious transition from forecasting cold hard cash in ATMs to predicting the equally volatile but far less tangible world of pharma stocks. Spoiler, it's like going from playing checkers to 4D chess while blindfolded, sort of saying. So, the quick agenda, we're going to explore a bunch of things, but pretty much we can summarize that in what I explored through the project. We will make a very quick benchmark on statistical models versus machine learning models that I aborted in this project. And we will abort a trading toolkit that we used during this project. At the very end, we will make a walkthrough in the Collab Jupyter notebook and explore the details on the long short-term memory neural network and the trading toolkit that I applied for this project. So some experience that I have, I did forecasting in the past, but I did inventory forecasting back at BBVA. My life was simple. My biggest worries were, will this ATM run out of 20 pesos bills by Friday? By the way, I'm from Mexico. That is why Mexican pesos. Did someone forget to account for payday weekend? And most critically, is the armored truck on time? So the variables were very physical, very accountable, and blessedly predictable. What happened if you missed a forecast? No big deal. Just stuff more cash into the machine. It was the luxury of tangibles. However, then we got to predict some companies, in this case, Eli Lilly's stock. And we can call that AKA the chaos machine. So the variables that we manage in this project is open price, close price, high price, low price, volume of transactions. But those variables were also affected by FDA approvals that we learned in the newspapers. Also, random CEOs tweeting about weight loss drugs, thanks Elon Musk, for instance. And also some companies classifying certain drugs just as bound as not cool enough. Basically, they classify it as pricing and didn't want to sell them, use them anymore, to buy them anymore. And the best part, no armored truck to save me, just market sentiment. So there are some lessons learned that I learned the hard way, and some key takeaways from my trauma is that cash in ATMs doesn't care about clinical trial results, for sure, while stock prices in LLLs care too much. And most importantly, in cash forecasting, you control the supply. In stocks, we can say that you can just pray and expect the best. So, despite the chaos, This journey taught me one golden rule. Forecasting is forecasting, whether it's cash or stocks. The tools change, but the thrill of the educated guess remains. And let's be real, Lily's drama is way more fun to explain at parties than ATM cash flows. So basically, we said, let's do it. So just let's make a very quick overview on what happened to Lily's. So pretty much, it's a pharma pioneer since 1876, and it has got some momentum since this Indiana-based company started with diabetes treatments, but now tackles everything from Alzheimer to cancer. Pretty much their secret sauce is heavy research and development spending. They're taking billions, literally, and they bet on bold science, like proving an obesity drug to treat sleep apnea. And as a fun fact, there was a moment where Eli Lilly briefly topped Tesla's as the world's 10th most valuable company, thanks to the glucagon-like peptide 1 receptor antagonist drug. Anyway, and there's a timeline, and we are putting some background to understand uh, what is the effect that is detecting that are detecting the models and on why they are not feeling it. So pretty much they have some momentum grown from 2023. And if we walk this timeline together, we can see how Eli Lilly's stock has had a remarkable journey, driven largely by their blockbuster drugs. So if we go to, let me get my laser. If we go to 2023, early 2023, it started with a very specific drug called Monjaro that was approved for type 2 diabetes, but the real buzz came from the unexpected effects on weight loss benefits. So pretty much investors in early 23, they realized that it wasn't just a diabetes drug. Some prescription source off-label, the use exploded, and Lilly's stock began to climb. And later on 2023, there was another burst about the approval for Zepbound from the Food and Drugs Association in the United States in November 2023. And it didn't just enter the market, it dominated. Within months, it hit the 1 billion sales, outplacing the competence that was a drug called Wegovy in trials. The stock, as you can see, they skyrocketed. And by early 2024, Lilly became the world's most valuable pharma company. However, there were some drawbacks. During 2025, there were some global push and challenges. Um, Very specifically, there were some supply shortages. In US and Europe, there was this high demand for outstretched production, so Eli Lilly invested 2 billion in capacity. There were also some China trials for potential 10 billion increase in annual market. But there was some payer pushback. Some companies, despite the strong financial results, some companies were reluctant to continue covering Zepbound as the drug for covering the weight loss. In this case, they prioritized another drug that is the competence Wegovy due to the lower price. So we will see that if we go back, if we go forward in a moment to 2025, we will see that drop in the values. So talking about the differences again between predicting how many widgets you will sell next month and trying to guess where a stock price is headed, again, it's like comparing a calm game of chess to a high-speed chase where the road keeps changing. So pretty much, see, with inventory forecasting, you've got nice, tidy data, past sales, seasonal trends, maybe a supplier delay or two. It's all logics and pretty much all spreadsheets. If you are off by 10%, no big deals. Just adjust next month's order. But the stock prices, man, One day your model's perfect, and the next day some CEOs tweets nonsense, the Fed changes its mind about interest rates, and suddenly you're sure think prediction is trash right now. So it's not just math. It's math psychology, breaking news, and sometimes pure chaos. And the tools, well, Inventory's Rocky, Narima models, and Excel macros, like in 1999, works perfectly. But in stock trading, right now, we are using neural networks trained to guess what's coming next. So at the end of the day, inventory forecasting is like being a librarian, organized, methodical, maybe a little boring. While stock forecasting, again, another metaphor, is like being a weatherman in hurricane season. So pretty much same job title, forecaster, but completely different blood pressure levels. So about the benchmark, this is kind of I wanted to start it from the results to make a very good comparison between a statistical model that we developed and a machine learning model. So in this case, let's say that the winners from each one was the Asarima model with no seasonality and a stack long short-term memory in neural network. So right now we're going to cover the findings of why we are not staying with a Sarima model, for instance. So pretty much why, as we go back in the results, the metrics that we have here that about moving very sorry, the average percentile error or the absolute error or the root mean square error, they look great in Sarima's model. And however, this is not the winning model. And this has to do with something that we said at the beginning. So why Sarima falls short for stock price forecasting? So let's consider this. The forecast is in red dotted line, and as we can see, the training data is the blue series, and the real test data is colored in green. So no need to say the forecast is falling short in the predictions, and it's also very conservative about the fluctuations. So what is the core problem about this? Pretty much Sarima relates in rigid seasonal patterns that we will see in a moment that they might not be present in the at the moment in this very specific enterprise. For this kind of forecasting, for stock market forecasting, we have to consider that we have dynamic seasonality. So the shifting cycles are present due to crises or trends. And also the probability of a black swan event happening is always present. So markets react to events that the principle of a black swan event is if an event has not happened yet, it doesn't mean that it won't happen. So pretty much that recalls COVID in 2020, for instance. So the long story made short, the forecast from Sarima falls short in the prediction. So in the meantime, um, what we can assume is that the metrics cannot capture the mistakes during spikes and crashes. That is what traders actually care about. And pretty much there's also a bunch of information that statistical models ignore. They ignore external data such as news sentiment, just like macro trends. They only learned linear historical patterns. And in contrast with more modern models, just like long short-term memory neural networks or even um, uh, LLMs like GPT and DeepSeek, well, they fell short on what's going on there. So pretty much Sarima in the usefulness of Sarima is like taking into account only the past without all the context surrounding. So let's break down a little bit what's going on with the information of this company LLEs. And for that purpose, we are going to take apart the time series to see what makes it tick. So pretty much, what are we looking at? Here's the actual close pricing values. That is the original numbers of the close price. That will be our starting point. And then from it, we can extract the trend by smoothing the values to get the big picture direction. So for instance, here we can see that the full data points have an upward trend, and at some point they just stabilized, right? So pretty much we have a gradual climb upward. And in a third place, we have the seasonality. As we said before, Sarima was doing great in the predictions, let's say in the metrics of error, since it didn't show a very strong evidence of obvious seasonality. And we can see that here, right here. If you see the seasonality factor, they're very smooth, gentle waves in repeating patterns at fixed intervals. Um, but in this case, check the magnitude. The magnitude, taking into account that LLE currently has prices over $800. So a variation between $5 and so on, perhaps gets wider here, $10, seems not to be very influencing, right? So there's a seasonality factor, but very subtle. It looks more like a gentle heartbeat than a drum solo to be taken into account. And finally, uh, all that it is not trend and is not seasonality, it's the residuals. We can think about the residuals as the leftovers after removing the trend and the seasonality. And here, let's recap some observations. So recapping the trend in the original series is smoother ascending with a general trend decelerating. About the seasonality, the magnitude of the seasonality is very small, and we consider that with the function auto-arima in Python, statistically insignificant, and that helps us because it simplifies the model. And finally, the key insight here is like the residuals look like white noise, this scatter plot confetti right here. And that's actually good news because it means that the model successfully extracted the trend and seasonality, and they're not hidden trends. So randomness is not present, let's say, right here. So as I mentioned, Auto-Arima was run in Python to pick a model, and it was right not to choose a complex model because no complex seasonality was needed here. So now let's start with a machine learning model, the stack long short-term memory that outperformed a Sarima model that is a statistical model. And let's see what was the setup for it. So pretty much it starts from a neural network. And for preparing the time series for long short-term memory, we need to structure sequential data. So I predefine a function in my code that to prepare the time series to train the stacked LSTM, the long short-term memory network. So pretty much what it does is actually very cool because we take the raw sequential data and we chop it into sliding windows of a fixed length. That will be our sequence length. So pretty much, how does that work? To predict the time t plus 3, I will use time t plus 1, and time t plus 2 all together. And to predict the following moment, t plus 4, I will use, conversely, t plus 1, t plus 2, and t plus 3 moments. So for each window, we will have in the input, in the matrix X, a chunk of consecutive data points or steps. And in the target, pretty much what we want to do is to hold the next value right after the window that we inputted, because that is what the long short-term memory model will learn to predict. So we pretty much ensure that this is converted to NumPy arrays, and we ensure that the data is ready for being trained in PyTorch. This is essentially how we teach the model to recognize patterns over time. Now, the way that it was configured, the key model parameters very plain explain. The sequence length that was set up to 120 days pretty much can be understood as how much history matters. Pretty much the LSTM analyzes the past 120 time steps or days in our case to predict the next value. It's like reading a 120 pages of a book to guess the next plot twist in the story. Also, we have the input size that pretty much is what is the input, how many variables we are fitting into the model. For our case, are pretty much the full set of open, close, high, low prices and volume. The more features you add to the context, it will be a richer context, but harder to train. Also, uh, we define the hidden size at 128. And what we can say about the hidden memory power of the long short-term memory network. So each layer was defined to have 128 neurons we can think about as brain cells, and they are learning patterns. If they were too few, they will not learn the patterns and they will be underfitting. If they were too many, they will overfit. Also, we're defining the number of layers that are the stacked LSTMS layers. In this case, we got two stacked LSTM layers for the model to learn hierarchical time patterns, like spotting trends first and fine-tuning them, the details. Furthermore, we have the epochs. Pretty much is the maximum number of times that the model sees the entire dataset. In this case, why did we choose 400? If it was too low, less than 100, the model may underfit again. And if it was too high, it would be wasting computing resources, and it will be early stopping before reaching that. And the sweet spot after some iterations was 400 epochs for convergence, with patience set to 5, just as this here. So what can we understand for patients? Pretty much, if the validation performance doesn't improve for 5 epochs, we will stop early. Why 5? It balances efficiency and model performance. Finally, we're almost there. We have the learning rate that we can think about it as the step size for weight updates during training. And this value is small enough for stable training, large enough for making progress. And the weight decay, finally, with dropout, the weight decay penalizes large weights to prevent overfitting. This by L2 regularization means. And dropout pretty much is choosing randomly 20% of neurons to force to let them out to force robustness. So some pre-processing was done on the long short-term memory neural network. Some feature scaling was outperformed was performed very sorry, and pretty much we must make sure that we are just including the training information into the scaling at this very moment. Why? Because we don't want the model to cheat. We don't want the model to see the test information or the validation information to learn the patterns on advance. So this is a very important topic, point that we need to take care of. And also we transform both train and test sets, but in different moments using the same scaler. Also, we reshape the data to flatten it, first temporarily to 2D and then restore it to the original dimensions. And in similar fashion, we scaled also the labels. Some tips for managing long short-term memory. It's very important to never scale the test data using the training stats. That is what we said before, just to prevent data leakage. And we need to verify that the dimensions of the y vector matches the model's output shape for multivariable prediction. And in this case, in the project, we use GPU acceleration. So we have talked about the parameters, and it's time for talking about the architecture. So pretty much what did we set up here? Pretty much we can think about this model as a very smart, as ultra smart reading assistant that actually learns from time series data. So pretty much what makes it tick? We will have a pattern decoder that are the two LSTM layers. The first one works for short-term patterns, and the second one for long-term patterns. And this is bidirectional. It's a very interesting and cool feature because you let in the same sequence in the training data for the each one of the values in the sequence to look either to the past or to the future. So each point can see the points that are previously considered and the points that come after it. So it verifies past future and future past relationships within sequences. Also, we have the attention layer that is kind of the news filter that ponderates high impact events. So this automatically weights high impact events like they are heavier than regular trading days. So it can learn what happens when the Fed speeches actually move the market and when they didn't affect a thing. And also we have the richest stabilizer. Pretty much what we are doing here is to normalize the volatility price swings. Uh, like for instance, if Tesla moves away 10% on a tweet, and this prevents extreme position during no never ever happened events, black swan events. So why do we care about this? Because this pretty much without this, one crazy volatility spike would distort the whole model. So pretty much this is the usefulness of the batch normalization. And at the very end, we're also setting FC layers that work as position sizers. In this case, I use leaky value that allows slight negative values that are more suitable for financial data than regular ReLU. And we got this extra dropout that makes the model less cocky about the predictions. So why LSTM beats traditional models for trading? So pretty much at news reactions, the classic model or ARIMA model ignores events, while the stack LSTM that I developed learns with events matter, which events matter. The volatility, the classic models break during swing, while the LSTM thrives on chaos, and you will see the predictions in a moment that reflect in a very fine way the fluctuations. And the position sizing, pretty much classic models use fixed rules, while LSTM adapts to the market, pretty much. So about the training, uh, pretty much we can see in this training versus validation loss, the training plateaued early in the epoch 20. So pretty much what happened, the model stopped learning from historical data, but kept improving on validation right here. That means that the validation set right here has patterns that are not present right here. So it's kind of interesting. All the patterns in the training data were learned pretty much in this section, and it is taking longer for the validation loss to do the same. And another thing that we can see here is that for the validation loss, is stopped getting better by the epoch 45. So we have a validation peaked here, and any extra iteration adds no value. So the final iteration, at the very end, check this graph here. Here we have what will be the forecast or the prediction, better said, from our LSTM model. So our model in the overall trend is well captured, since we can see that the peaks and the drops are kind of well behaved and aligned with the general shape and size of the original series. But however, it's somehow optimistic, right? Since the predictions are a positive offset, they're inflated compared with the original series. A So what we can conclude from here is that the model is great at spotting trends, but we need an adjustment uh, to stop, let's say, this model from not capturing the actual trends. And we cannot blame the model, because if you see the previous historical data, the trend was going upward. And if we remember, we set up the sequences to consider the 120 days before each. So pretty much it is just reflecting the trend of the last sequences that are taken into account. And well, also as we were saying, the fluctuations somehow are also, if somehow reflected, the values are inflated, as we said before. So with that we conclude the forecasting models or the prediction models that I awarded. These are the two main models that I awarded during my project. And then I was given a task that was, okay, you have somehow a cross-worthy model, and now how can we work with the model in such a manner that it can let us have signals of when to buy, when to sell, or when to do nothing. And that's where our trading toolkit enters. So, to be honest, the toolkit is vast. So, here in this screen, we can see that there are many more of them. But right now, for this project, I focused on five main kits, that core technical indicators. I use Bollinger Bands for detoning or for triggering the primary signals, as well as candlestick patterns. That is a very, very cool thing that tries to capture sentiment of the market. And to confirm those signals, I used both moving averages and first and second derivatives that is hidden here in the about below this line. And furthermore, I explored the moving average convergence divergence, and they have some very, very interesting things to be said. So, about the moving average, pretty much what is the advantage of using this as a confirming tool? Because it smooths out the market noise and helps identify the overall trend. So the moving average is a fundamental technique that smooths out price data and identify trends over time. If we combine that with Bollinger Bands, it serves as the basis for the band's construction. Typically, a 20-day period, simple moving average is set up as the central line. With this average, we help traders assess whether prices are relatively high or low within the given context. And if we use that with candlestick patterns, we can confirm bearish or bullish signals for those that are struggling with this term. Pretty much when we say bullish trend, it's an upward trend. Is the stock values, the stock prices are rising, and bearish signals mean that the stock prices are going down. So, for instance, bullish candlestick patterns forming near a rising moving average can signal a strong continuation of opportunities, adding confidence to trading trading decisions, let's say. Why is it limited? There's some lag behind the price action because it is based on the data. We are calculating that moving average with the past information. And since it is past information, it is not sensitive to external shocks or the sentiment of the market if there's a shock. So it may produce false signals in sideways or highly volatile markets. And it requires adjustment depending on what market you are working on. So for beginners, it might be challenging. Another thing that it is not considering is that the trend reversals are not well predicted by a moving average. So the moving average can only confirm the reversals after they happen. So very much the recommendation is not to use the moving average alone. It must be used together with another set of tools, such as the first and second derivative. So pretty much the first and second derivative that were used here identify the momentum strength, and they help validate the breakouts or trend continuations. So we can think about that as the rate of change of the stock price value and the rate of change of the rate of change of the same. So if we combine this again with other tools like candlestick patterns or Bollinger Bands, we're setting up a combo that combined will help us a lot. So now this is what comes next is actually a very robust tool that is the candlestick graph. So what does a candlestick graph tells? If you see, it resembles a box plot, but it is not precisely a box plot. At each day of the series, the candlestick shows all the prices that are accumulated in the record. So pretty much it shows the opening price, the closing price, the highest price in the trading day, and the lowest price. So what it tells is price movement in time. And some of the shapes that this candlestick take can let you know what is the market sentiment and advise you about trends and reversal patterns. So how does that work? Pretty much if we can analyze patterns, the traders can identify when is it going to change the trend upward or downward, and in what moment is that potential reversal happening. So there are many shapes that can help in that manner. Some of them are doji, engulfing, hammer, that can indicate those changes in the market. Right here, for instance, we have an inverted candle, hammer candle, that refers to the shape of the candle in the middle that indeed looks like a reversed hammer. So pretty much it's a very helpful visual aid in technical analysis. This helps traders to interpret market sentiment and potential price movements. One of the advantages that it has is that it conveys a large amount of information that includes all the four prices that we have by default as our input in a very compact and intuitive format. We are reading four different values in only one figure all at a time. So they are especially effective when we want to identify short-term reversal and momentum shifts. However, these patterns have some limitations. The reliability often depends on the context and the time frame, and they can be subjective or misinterpreted if we have no confirmation from other indicator, just like the moving average or any other. So also we can have false signals. So the goal here is to have very clear true signals. And that is why using all these tools, we end up setting up a combo of tools. So we get three forms to get signals that are confirmed. One of them will be proactive signals that will let us know in advance when a shifting move is coming. And those proactive signs, those proactive signals, we'll be using together candlestick patterns, Bollinger Bands, and moving average. So in this case, pretty much in low case, on a very small size, we have the raw candlestick patterns that you can see in red and green, very small triangles, either pointing upward for buying or downward for selling. But once they're confirmed with the highest 25% of the values of the derivative or the lowest 25% of the values of the first and second derivatives, that means that we're confirming the either the rate of change is the 25 higher or the 25 lower. When we say lower is very negative. When we confirm those candlesticks with that signal, here we're indicating with very big signals when the signal is confirmed. And how can we interpret this? So pretty much, let's take into account, for instance, this signal here. The model is using 60-day moving average, if I'm not wrong. So pretty much here we have the raw trading signals, but since the confirmation of the moving average is not yet there, until we fulfill the 60 days, check this out. What this signal is saying is, behold, or an upward trend is upcoming. And in fact, it is coming. We have a small peak right here. And later on, it is very interesting what is happening here. So just after there's a turn, the candlestick pattern confirmed by the moving average is letting us know that a shift upward is coming. And in fact, check this out. This is a sustained change that lasted 3 months. That it has to do with all the externalities that or events that we studied for LLD before. It has to do with the approvals of drugs, with the results of testing, and so on. But these signals are well suited for giving proactive signals. So what is the proactive attitude that a trader must have? Okay, I have a proactive signal. I will watch the performance of the stock and find the highest moment until my risk appetite is satisfied, right? So as you can see, pretty much the signals that are set up here are uh, buying signals. And now you would say, okay, but here we have a trend that is stabilizing. I don't know why it is recommending to buy if there's no evidence of going up. And you're right, because what we have set up is that it must be based on the moving average of the 60 days previous. So in this case, there's an horizontal trend that includes somehow the upward trend and then recently changed stabilized trend. So that is why we have that kind of signal. Also, if we use Bollinger Bands, that pretty much it's a dynamic adjust to market volatility, and it's a very popular technique analysis tool that will help traders identify potential overbought or oversold conditions by measuring price volatility. So pretty much we are working at 2 standard deviations from the moving average that is going on in the central line of a series. So pretty much when we surpass either the lower limit or the higher limit, signal is the tone. However, it has its limitations. It's not to be provided as a standalone buy or sell signal. It must be confirmed by any other technical indicator or price action analysis. Since that is what it is, it can generate false signals in sideways or low volatility markets. And how our signals look when that happens. The principle behind Bollinger Bands, that are the red, the green and the purple line, dotted line that we have in the series, is that if we go beyond those limits, we expect the series to shift, to have a turn, pretty much. And as you can see, each time that this actual series is going out those from those bands, a signal is determined. But again, we need something to confirm it, and that's why we are going to use the first and second derivatives, and also the moving average. And that's how we are getting a signal that we call a reactive signal, because it is letting you know that you must buy in the very moment. So this is kind of a very useful tool, but it is very reactive, and the trader might fall short when making the transactions. And finally, and that is quite a very interesting tool, the MACD, moving average. Pretty much what this tool does is, for those who have very low risk appetite, why should a trader with low risk appetite be hunting the signal or waiting for the signal to happen if it can buy, or if he or she can buy the stock prices after the turn has happened? So pretty much this is what MACD does. So it identifies trend, direction changes, and momentum. And pretty much the logic behind it is, we will have two moving average going on. One will be a moving average line, and the other one will be called the signal. Each time the moving average is greater than the signal line, we can call that a bullish trend. And if the MACD line is below the signal line, we can call that a bearish trend. So again, the limitations is that it is based on past information, so it can delay the signals, somehow not sensitive to news or to events, and again, they need confirmation. So what is the logic here? I would like to show you um this pic here. Check this out. At this moment, we have a moment where the what's that? The MACD line surpasses the signal line. The signal line is the yellow line. So at this very moment, when the MACD surpasses the signal line, we get a buy signal, since we are expecting the trend to go upward. And it's correct. But the funny thing is that it is letting us know once the change has already happened. So if we could zoom at this section, we could see that the U-turn has been already taken for this proposal. That is somehow more visible right here in this signal, this confirmed signal, where the U-turn has already taken place, and then that is when the signal lets the trader know, okay, a turn of direction has happened. It would be a very good moment to check for buying, right? Anyway, so just to finish out the presentation, some very key conclusions on this. For the model that was a winner model, the stacked long short-term memory, the advantages that it presents is that it captures complex temporal patterns. So that was pretty much, the shape and size was very well reflected. However, it didn't represent the values very accurately. It involves some computational efficiency. It has built-in regularization that is a very great feature. And it presents both recurrent dropout and weight decay to prevent overfitting. And the interpretability is great on this. What are the limitations? Um, Computationally talking, it struggles with very long sequences, above 500 steps. And this model, I must say that during this work, it was a very iterative work. And what I learned is that parameter sensitivity was high. So fine tuning is well recommended for this kind of work. About the trading toolkit, so pretty much Bollinger Bands, candlesticks, MACD, first and second derivative, all together in a combo are a very winning combination. So um, it is just a matter of recognizing that even with all combined together, we can have false signals because we are lacking of information that we could nurture our model with. So where not to use it, we should avoid cryptos or stock markets where the price is very low and the volatility is high. So for future work, we can think of hybrid models that could combine long short-term memory with fundamental data, like the news about the FDA approvals, the earnings of the companies to reduce prediction lag. We could fine tune some parameters like dropout and attention layers to prevent the overestimation. And something that, in fact, I was kind of sad of not integrating into the project is the incorporating real-time sentiment. So we could integrate natural language processing from news, social media to capture sudden shocks, um, like actually quantifying the sentiment of the market. Also, something that must be worked on is backtesting in a robust manner. So this can be applied through multiple market regions. At this very moment, this model is tailor-made for this company. So it is important to validate the strategies to make it more generalistic. So also the risk alerts. A strong recommendation is to integrate volume and volatility indicators to filter false signals. And finally, to adjust in an automatic manner the parameters based on macro conditions like interest rates and any other external data. So the lesson learned. So pretty much we could stop predicting the market and start out maneuvering it. Pretty much, perhaps we don't want to know the exact value, but we want to know when to react in a timely manner. And finally, if you enjoy the talk, here's my contact information, my LinkedIn information, as well as my email. Thank you so much for attending this workshop. And if you agree, we can open the Q&A session.
Thank you so much for, insightful and engaging session, Japhet. So here's the time for raising your questions. You can, ask anything that regarding the whole presentation. So no questions.
Yes, actually, I have a question, please.
Perfect.
Thank you, Jeff, for the presentation. Lovely one. Like where you did the loss, where you showed us your loss graph.
Oh,
So you
yeah.
had,
Let's go back to it.
yes, please.
1 second. Okay. This one.
Yeah. So like I'm not sure like how it works, but I know like I mentioned that I'm taking a course in Coursera, but from the little that I learned, if your loss should decrease when you're training your model, right? So, but I see that with the validation graph, your line at some point was increasing. Is this okay?
I mean, that's like the best that we could get with the validation information. So as you said, yeah, we are expecting both training and validation
Decrease.
to be decreasing in loss. But at this very point, the interpretation is that we are starting to overfit.
Okay.
So pretty much it would be the best scenario, right? We would like very smooth lines that are practically one an offset of another
Hmm.
and smoothly parallel and live happy forever after. However, as I was mentioning before, it's like it was a very iterative process, and something that I want to work on is the fine tuning on this. Uh, Perhaps either by making a hybrid model or only by means of a fine tuning, we could get this to be a nice offset, just as you are mentioning, and to reach closer values, right?
Hmm.
But that also depends on the data. Something that I mentioned during the presentation is that a very interesting phenomena is that the training patterns were learned very fast,
Hmm.
while the validation pattern seem to be not the same that the ones that are in the training. So there are some patterns that are not present in both sets, and it would be very interesting to find ways to guarantee that those patterns are learned from the very initial training curve. But yeah, thank you. Certainly, you're right. We would expect the like the best scenario would be a very nice graph where we have two lines in an offset going together with a small differential between them. So certainly, it's a future work line for my project. Thank you so
Okay.
much for the credit.
Thank you very much.
I have a question.
Yeah, all
I just wanted to ask, did you look at anything related to profitability? So did you look at different profitabilities between each model?
not really like running a simulation, right? Yeah, that's something
Yeah.
that was left. I have been experimenting with backtesting a library from in Python, and it was left out of the reach of this delivery right now. But certainly, it's a future line of work in that aspect. It's a very cool library that, for those who are not familiar with it, you can run scenarios with a very initial capital scenario, and by implementing the trading strategies that we have here, you can make compete your strategy setups for that. So certainly, it's a very cool thing to be done in a work like this. Unfortunately, for means of the submission deadlines, I was not able to conclude it. But certainly, it's a very interesting thing to work in.
Yeah, no worries. Thank you. Yeah, definitely like comparing just like a buy and hold strategy and then the strategies that you have. Also, you mentioned semantics. I would maybe suggest not necessarily like news articles, but like what's really good for like learning about a company is the SEC filings. So like the quarterly reports and whatnot, because
Totally.
those will tell you exactly what's going on with the company, and you can look at all sorts of variables in there. So those are very worthwhile looking at, I would say. But yeah, good stuff. I thought it was really good. Nice.
Yeah, and I totally agree because typically the first quarter report makes the market tremble.
Yeah.
So that kind of thing makes a very good effect mirroring of what's going on
Mhm.
on the sentiment on the market. And yeah, totally, it could be another input, and in fact, a quantitative input. If it would be very interesting to include it.
Awesome. Awesome. Yeah.
Thank you, Paul, for your contribution. It's awesome,
No worries.
awesome.
Yep.
Elim, so we have a question from Ayush Anand. Um, can we share it? Can we share the presentation?
Yes, of course, Japhet. Is it okay
Well,
with you? Of course. Please go for it.
no problem.
Mm-hmm. Thank you.
Excellent. Okay. So, any other question? Also, I'm very sorry. I don't know how much time we had, Zeynep, because the walkthrough was gone.
Yeah. No
But
worries. This session time was an hour. However, the Q&A session due to it, so we can, get the questions, and in a couple of minutes, maybe we can cover the unskipped areas as well.
excellent. Well, just to take advantage of this moment, I just want to thank everybody for attending this session. Uh,
Mm-hmm.
I want just to show my appreciation to all of you. It's I know how hard it is to find a moment in your agenda, so I appreciate it. I appreciate it from the bottom of my heart. And for those who are, oh, yeah, there's Eugene. Hello, how are you?
Hi, I was supposed to click some emojis, but accidentally clicked another one.
Oh, no worries,
No
Eugene.
worries, no
Yeah,
worries.
and thank you for
It's
your
a pleasure.
presentation.
Thank you for attending, Eugene. So for those who are in the moment of whether or not considering to join AppSiva, I just want to tell you the experience is amazing. The follow up is one-on-one, and I couldn't be happier with what has happened to me during my experience here. So please do not hesitate if you have any question regarding my experience or any other of the residents. Feel free to contact us. There's social networks going on, LinkedIn, Facebook. So please feel free to ask for first-hand opinions on this. And believe me, my learning curve has drastically accelerated during this time. The advisory and the mentoring sessions are priceless. The follow-up on your job strategy, job search strategy is just wow. So anyway, feel free to contact us, and I'm very happy to be present on this presentation and to have exposed in it. Zeynep?
Mm-hmm. Thank you so much, Japhet. Again, the insightful words and also your feedback about the program as well. Also thanks all of you for joining us today and staying curious about AI. So until next time, please take care of yourself and keep exploring the power of AI in solving problems. So pleasure to meet you, all of you. Have a good rest of your day.
Thank you, Lipsu. Thank you, everybody. I see you
Yeah.
around.
See you. Thank you so much.